This is our first lecture related to Chapter 11, which focuses on the inventory and purchasing cycle. Keep in mind that when we're working through the inventory and purchasing cycle, that we're considering it from the transactional perspective, where we're looking at internal controls, and we're also looking at account balances, where we are measuring monetary misstatement. As we consider these processes or these cycles, what we need to understand is what are some of the accounts and what are some of the transactions that we need to consider as we are doing our review from the perspective of an auditor. So what you see here are various T accounts. You notice that the primary accounts are accounts payable and inventory or inventory purchases. You notice that when we make the purchase and we receive the goods is we have a debit to inventory and we have a payable to accounts payable. When these items are paid is we debit accounts payable and the credit is going to cash. So cash payment is part of the transaction that we're looking at. Depending upon whether this is a merchandising inventory situation or a manufacturing inventory situation, we may have accounts such as factory overhead, we may have cost of goods sold, and obviously we're going to have expense accounts as these goods are actually sold. The cycle is critical to our understanding of what internal controls become important. And as we consider business cycles, we need to understand it from the beginning point to the end point. So what we have is the payment cycle, the purchase and payment cycle as it relates to inventory and accounts payable. So you notice the very first piece of this is the requisition of goods and services. In a well-run organization, this requisition is coming from the department level. The requisition is based upon the requirements for that specific department, but the department is not actually ordering the goods. The requisition is going to the purchasing department. The purchasing department is responsible for ordering the goods, for developing contracts with vendors, for identifying pricing, for identifying appropriate vendors, and so forth. The purchasing department makes a purchase requisition. This purchase requisition goes to the vendor, and these goods are actually ordered. When they are received, they're received by the receiving department, and we acknowledge the receipt and account for these goods and services. Essentially what we mean is that the receiving doc will record and count the items that have been received and enter these into the computer system. The receipt of goods in most systems is the starting point where we increase inventory and create an accounts payable. So the next step of the process is the actual approval for payment. The approval for payment comes from the accounts payable department. The accounts payable department receives an invoice from the vendor. They then match this invoice with what was received and what was purchased based upon quantity, goods, as well as pricing. Based upon this three-way match, if in fact it does match, then accounts payable approves for payment. This approval then goes to cash disbursement, where the payment is made and the voucher that's been created by accounts payable then is canceled. And the idea we're canceling the voucher is to make sure that this item is not paid twice. When we're considering this, what we want to look at as to inventory as well as accounts payable relates to how these inventory balances match with these management assertions. Keep in mind that management assertions are the explicit or implied statements of management as they relate to inventory balances or account balances in the financial statement. So the first is existence. When we're talking about inventory, we're clearly talking about existence, not occurrence, but existence is the inventory balance as of the balance sheet date. This is going to be validated based upon an inventory count. The next piece is completeness. We want to make sure that the inventory balance represents all transactions that have taken place during the period, rights to the inventory. We want to make sure that the inventory is there and we have legal title to this inventory. There may be goods on consignment. There may be bill and hold situations. There may be situations beyond this that the inventory is there, but we don't have legal title to it. Valuation, clearly we want to record any underlying economic value changes. As we're considering inventory, we want to consider it from the perspective of the lower of cost or market, and this becomes part of our examination evaluation. Presentation and disclosure, we want to make sure that it's presented correctly and classified appropriately. As we're considering the next piece is we want to identify the inherent risks related to inventory. Keep in mind that inventory is a complex accounting and auditing area. It usually includes material amounts that are material to the financial statements, and these are subject to manipulation. Large number of inventory related frauds have been perpetrated, and it requires an exercise of a high level of professional skepticism from the auditor. Inventory is prone to fraud. We absolutely need to understand fraud risks as it relates to inventory. The primary issue related to fraud is what we call inventory shrinkage. This is a term that's used that basically reflects inventory that's lost based upon it being stolen from employees or other people that may have access to the inventory. Employee schemes involving fictitious vendors as a means of transferring payments to themselves is another risk. And anytime we're dealing with inventory and purchasing is we need to understand that we are consuming a tremendous amount of resources within the organization. And if we don't have the appropriate controls, it's very possible that in fact some sort of fraud is going to be perpetrated. You notice here related to control issues in the requisition process. And again, when we talk about inventory, the purchase of inventory is we need to continue this from the perspective of the items are requested, they are then purchased, and then they're received and the payment is made. Now you notice that there's some very specific segregation of duties there. So as we had pointed out, it's critical that the requisitioner is not the one that actually purchases the good. It's very important that the purchasing department is in control and management of vendors, of pricing, and the actual purchase of goods and services from the entire organization. Receiving is a separate department from these other two departments. Receiving is only responsible for receiving and acknowledging receipt of the goods from vendors. And then finally, accounts payable, separate department, and they are responsible for approving payment. This approval of payment is based upon quantified information from the purchase order and from the receiving as well as from the invoice. But the issue related to inventory is going to be different compared to whether it's a manufacturing organization, a retail organization, a just-in-time manufacturing, or where we're considering supplies. Now the difference between supplies and inventory is inventory are the things that we ultimately sell. Supplies are these goods that we purchase where they are consumed in the revenue process, but they're not actually sold to the end user. Each of these have unique situations in terms of controls. Clearly the difference between a manufacturing organization and a retail organization need to be considered. In manufacturing, as we develop inventory, we're going to have absorbed cost from direct labor, from direct materials, as well as overhead. All these items then flow through work in process and finished goods. We don't have that in a retail organization, but we do have other unique situations that create issues from a control perspective. Controls related to the purchasing of goods and services. We've talked about a number of these things. Clearly, the biggest control is the segregation of duties. Absolutely critical that the organization established specific functions and roles within these specific departments to control the process. We need to have approval of contracts with suppliers. We need to identify who actually approves this. In most of the situations that I've worked in, it's the purchasing department that approves these contracts and is the only group that has the ability to actually enter in a new vendor or even change information in any of the vendor information, which means that we need to have restricted access to the computer program. This restricted access to the computer program needs to be on a role-based perspective. In an ERP system, the ERP system is developed from the perspective that the material or the information that flows through the information is within and crosses over various departments. However, with role-based restricted access, receiving, as an example, only has the ability to enter the amount of items that's been received. Purchasing only has the ability to actually purchase goods and manage the vendors. Accounts payable only has the ability to approve based upon these prescribed values of purchased, received, and pricing. To avoid the risk of purchase agents entering into kickback arrangements with vendors, we require competitive bids. We rotate purchasing agents across the product lines. So not only do we have the segregation of duties between departments, we need to also consider the controls within a very specific department. And so you notice here that within the purchasing department, we have some very specific issues that we need to contend with. Companies also need to consider other controls, such as the maximum quantity that can be ordered within a given period of time. Most of the modern accounting systems will keep track of quantities, will keep track of who's ordering what, and certainly from the requisition perspective, it's very important that the requisitioner, which is coming from the department level, is the only way that a purchase order can be initiated, and this requisition is going to be driven by a restriction of what can be ordered, the actual quantity, and a lot of this is developed based upon the budget constraints within the organization. We need to understand the minimum amount of previous usage during a specific period of time. And again, as we're going through this, notice how the budget absolutely relates to the controls related to the purchase of goods and services. We require a review by purchase agents for accounts or for some high dollar levels. Embedded within the system, there needs to be controls that if an order goes over a specific quantity or price, that these need to be approved at a higher level. And again, as we're talking through this, keep in mind that we're talking about the goods and services for the operation of the organization. We're not talking specifically about the capital items. Capital items are going to have a very specific control process, even though they may be going through this the standard purchasing cycle of requisition, purchasing, and so forth. So we need to understand that the capital items are going to be treated a little bit different, or in fact, they should be treated different. And if they're not treated different, it's very possible that this is a control issue. Receipt of goods. The receiving department should make sure that only authorized goods are received. Goods meet order specifications. There is an accurate count, and accountability is established to assure that all receipts are recorded. In a well-run receiving department, as items come off the truck, essentially what the receiving department is going to do is they're going to consider opening some of the boxes. Sometimes that's not appropriate, but they're going to count the items, compare that to the packing slip, go to the purchase order within the system, and record the receipt of what was actually received. Now, receiving also has the responsibility of delivering these goods and services, or goods, we're talking specifically about goods, to the to whatever user departments we're using, or the inventory depot, wherever they go. The idea is the receipt of the goods and at the loading dock needs to be accounted for, but also the receipt of the goods at the end user, whether the department or the inventory depot, also needs to be managed. There's a term that we use in accounts payable. We call this the three-way match. The three-way match is the purchase order, the receiving information, what was received, and the vendor's invoice. Purchase order basically has the items that were ordered and the price that these items were established at the point of order. The receiving dock is entering what has been received. The vendor's invoice, when it comes in, essentially identifies what was shipped and and the quantity and pricing. So the three-way match is at accounts payable. Accounts payable will consider the purchase order, the receiving information, compare this to the vendor invoice, and if there is the match, then this item can be approved for payment. Discrepancies, it needs to be reviewed with the purchasing agent. Supporting documentation and authorization are presented to accounts payable for any discrepancies before these items are paid. Now, keep in mind that in my experience, the biggest problem related to this three-way match is going to be the charge for shipping. So there clearly is going to be some sort of charge. This does create some problems in terms of the three-way match. But again, the complexities related to the three-way match need to be addressed within policies and procedures within the organization. It's very critical to make sure that these items get resolved appropriately, because what may be happening is the payment for the invoice goes outside the process. Well, the problem with that is if the item was received appropriately, the receiving essentially creates the liability. So we may still show a liability on the financial statements when in fact that item has already been paid because it's been paid outside the system. So when there's discrepancies and the system is not allowing you to make payment because of these discrepancies, these need to be resolved appropriately so that there is no bad effect on the financial statements. I won't go through a lot of these ratios. These are in your books. But the idea is that as we're gaining an understanding of analytical procedures, and keep in mind that we're talking about analytical procedures here in the planning stage. So we're not using analytical procedures at this point for our substantive testing. But you notice that we have inventory ratios, accounts payable ratios, and we're using these essentially to identify things that have changed from the last period. And again, they may have changed for appropriate reasons, but as we're looking at changes, this essentially is directing our attention to what we need to look at as we are assessing the risk of material misstatement. Factors suggesting a heightened risk of fraud in the acquisition and the payment cycle. So we've talked a little bit about fraud related to inventory. Now we're talking about fraud as it relates to the purchasing cycle, as we are acquiring and paying for items. An unexpected increase in gross margin, inventory that's growing at a rate greater than sales, expenses that are either significantly above or below industry standards, unexpected increases in the number of suppliers, capital assets that seem to grow faster than the business, expense accounts that have significant credit entries. These credit entries may in fact be some sort of adjustment that we are essentially negating some sort of fraud. And in travel and entertainment expenses, no question about it, but that one of the tasks that we have as auditors is to examine travel and entertainment. This is the potential for fraud, especially in high-level employees within the organization. As we respond to these identified risks of material misstatement, we need to develop an audit approach that includes test of controls, substantive procedures, test of details, substantive analytical procedures, and identify this from the perspective of sufficiency for each relevant assertion. Let's just take this just a little step further. Just make sure that we understand what we're talking about. Test of controls if applicable. As we are conducting our risk of material misstatement, so as we're conducting our risk of material misstatement, we are considering the risk from the inherent perspective. We're also considering the risk based upon our test of controls. The test of controls and the inherent risk defines our risk of material misstatement. The risk of material misstatement is then used to determine the nature, timing, and extent of our further procedures. Some of these further procedures will be additional tests of controls if in fact we are conducting an integrated audit relative to Sarbanes-Oxley 404. But if we're only doing a financial statement audit, these further audit procedures are substantive procedures. These substantive procedures is where we are measuring monetary misstatement. We're looking at the test of details related to account balances, and we are considering substantive analytical procedures when they're applicable. Again, the bottom line related to our substantive procedures is we are measuring monetary misstatement. We need to consider these appropriately and determine if they're appropriate and sufficient for each relative assertion. And again, as we're considering the assertions, we're considering these from the perspective of these implied or explicit statements related to financial information that are embedded in the financial statement. And as we've talked about, the financial statements are the responsibility of management. Okay, so we've started a very good beginning related to our discussion related to inventory and the purchasing cycle. We will continue this in the next lecture. Thank you very much.